Welcome to This Explainer, where we're going to dive into the dramatic, literally life-or-death survival tactics of two colossal American retail chains. You know, when we think about corporate history, it rarely involves successful reinvention. Actually, most legacy companies that dominate an era eventually just kind of fade away when the market shifts. But today, we're looking at a rare exception. We'll be tracing two retail empires that grew up side by side, faced the exact same existential threat, and chose two radically different paths for survival.
And what's really fascinating is that the massive retail empires of JCPenney and Target both trace their roots back to the exact same starting line, the year 1902. It's a perfect parallel that sets the stage for a century-long business experiment.
Let's kick things off with our class of 1902 and look at the two very different founders at the heart of this story.
It's honestly a tale of two completely different visions. Take James Cash Penney, for example. In 1902, he took his life savings of $500, borrowed a little bit more, and opened a rural, cash-only dry goods operation in a Wyoming mining town. He promised one fair price and absolutely refused to accept mining company script. Then you have George Dayton, who approached retail from a totally different angle. He was a real estate investor who bought a church property in downtown Minneapolis, lured an existing store called Goodfellows to the site, and eventually bought it out. So Penney built a rural, cash-only empire, while Dayton leveraged real estate to build an urban powerhouse.
Moving into their golden age, both of these companies experienced absolutely massive growth.
Things moved incredibly fast for both of them. By 1913, JCPenney was growing so rapidly that it incorporated and moved its headquarters to New York City, just to be closer to suppliers. Dayton's, meanwhile, remained private and fiercely loyal to its local community. In 1946, they instituted a famous policy of giving 5% of their pre-tax income to charity. By the 1950s, new generations of leadership had taken the helm at both companies. And get this, in 1956, Dayton's literally invented the modern suburban retail experience by building Southdale in Minnesota. That was the nation's very first enclosed indoor shopping mall.
By the 1950s, traditional department stores felt entirely invincible, right? They were the dominant retailers from coast to coast, the biggest buyers of newspaper ads, and the undisputed centers for community events. But a massive disruption was looming just over the horizon. Which brings us to the 1962 discount threat and the unstoppable rise of the price busters. Keep the year 1962 in mind. It is an absolute pivot point in American business history. This is the moment the landscape changed forever for legacy brands, forcing both of our subjects to make massive, life-altering strategic decisions.
So what exactly happened in 1962? Well, the discounter invasion. A completely new breed of retailer emerged. They bypassed all those fancy downtown locations for plain, one-story warehouse buildings. They used cheap fixtures and just packed them to the brim with factory overstocks. Instead of elegant fashion marketing, they ran dense black-and-white newspaper ads, boldly calling themselves price busters. Legacy merchants were utterly repulsed by these dirty, ugly stores, but, you guessed it, customers absolutely loved the low prices. In fact, 1962 was the exact year that both Kmart and Walmart launched. Talk about a real game changer.
This created a terrifying dilemma for traditional retailers. How in the world do you fight off these discounters without destroying your own highly profitable legacy stores? I mean, think about it. If you open discount stores yourself, won't your customers just leave your fancy department store to buy cheaper goods at your new discount store?
Which brings us to a really tough business concept: corporate cannibalization. This is the ultimate willpower test for a legacy brand. Are you willing to eat into your own sales to secure your future? Because the harsh reality is, if you don't cannibalize your own business, a competitor certainly will.
Faced with this very threat in 1962, we see two totally different reactions. The Dayton brothers decided to take the leap. They deliberately chose to cannibalize their incredibly profitable Minneapolis department store to open an upscale discount store concept they called Target. JCPenney, on the other hand, played it much more cautiously. They entered the mail-order business by buying a Wisconsin firm, and they did experiment with some discount stores called the Treasury. But strategically, they poured their primary resources right back into protecting and expanding their traditional full-line stores.
This leads us right into the Great Reinvention and the brutal survival tactics required in a rapidly changing market.
Now, Dayton's transition wasn't an instant success story. Actually, it was incredibly painful. Target was really expensive to build, and early on, if the stores were too nice, customers just assumed the prices were high.
In the early 1970s, Target struggled so much that Dayton stock collapsed, and Wall Street analysts actually demanded the company sell off the stock entirely. The pressure to abandon this discount experiment was immense.
Throughout the 1980s, this whole era became a true test of corporate Darwinism. Dayton's? They just ignored Wall Street. They had the corporate will to pour capital into Target despite the heavy backlash, treating retail like a giant R&D lab. They tested up to 18 different concepts, including founding B. Dalton Bookseller. Meanwhile, JCPenney recognized they needed to pivot too. Realizing malls were essentially centers for apparel, not washing machines, they kicked off a massive $1 billion facelift. They drastically dropped hardware, appliances, and auto centers so they could focus almost entirely on mall-based fashion and home furnishings.
Dayton's ultimately completed what is arguably one of the rarest feats in business history. Step 1, launch Target. Step 2, experiment aggressively. Step 3, in the year 2000, recognizing where their future truly was, they literally renamed the entire parent company Target Corporation. And Step 4, the absolute ultimate act of cannibalization. In 2004, they sold off their original founding department stores entirely. The offspring completely consumed the parent.
So, looking at these two entirely different paths forward, where did that leave them in the modern retail landscape? Let's look at some hard numbers from 2019 to see how JCPenney's mall fashion pivot stacked up against Dayton's total discount reinvention into Target. Because Dayton's legacy department stores were eventually consolidated into Macy's, we'll use Macy's here as the proxy for the traditional department store sector. And wow, the data vividly shows the massive financial payoff of Target's pivot. Target's revenue was a staggering $77.1 billion, over 3 times that of the traditional department store group. Target's net profit was $3.3 billion compared to just $564 million for the department stores. Their return on assets, which is a crucial measure of profitability, was almost triple.
And let's talk about the efficiency of Target's model. We all know Walmart is the undisputed giant of discount retail, right? But look at the net profit margins. By sticking to their upscale discount vision, the exact same vision that Wall Street punished them for 40 years prior, Target achieved a 4.3% profit margin. That significantly outperformed both Walmart at 2.8% and the legacy department stores at 2.3%.
So, what can we learn from this? The key takeaways from these parallel biographies form a literal playbook for corporate survival. First, you need corporate will, the unwavering commitment to take massive risks and endure Wall Street punishment for a future vision. Second, the willingness to cannibalize. You have to be prepared to sacrifice your own cash cow to fund the future. Third, institutional values. Through all the chaos, you need an anchor of strong ethics and employee support, kind of like that 5% giving rule Dayton's held onto. And finally, constant experimentation. You can't just be a store. You have to treat your business like an R&D lab, testing new concepts relentlessly.
I'm going to leave you with a final thought to ponder as you look at your own industry, your career, or your own business. What got you here won't necessarily keep you here. Does your organization possess the sheer corporate will to reinvent itself, even if it means deliberately dismantling the very foundation that built it? Thanks so much for joining me on this explainer. I really hope this deep dive provided some fresh perspective for you. Keep questioning the status quo and never stop learning.